Welcome to the July Galileo Capital Monthly Update. It's a little bit of a different format and different setup from normal because we have Yolande with us today, Yolande, who heads up our wealth business. Welcome, Yolande.
Hello, Warren. Nice to chat to you.
So we're getting a fair number of questions from our clients. We're actually asking for questions now that we can cover in these monthly updates. And so we decided today that I'd be in the hot seat and that Yolande, you'd have the chance to fire the questions that we're getting from our clients. And so over to you.
Well, thank you, Warren. I think most top of mind at the moment is the supplementary budget speech that was delivered by Tito Mboweni. What is the most important things that came out of that for you?
I think the first thing for me to note is that it is a really hard budget. It's a budget for tough times. It's a budget for, I think they might even have used the word war, like a war footing. And so looking at our country, we're in a situation where, our businesses are not generating money, which means they're not able to pay tax. Cost bases are rising as usual. And we've got additional costs. We've got the cost of trying to support the economy, the health system, through this COVID crisis. And so I think that it's a really difficult and sometimes scary budget. And I think if we look at what Tito spoke about around the debt levels of the country, we're getting to debt levels that are nearly unsustainable. And so the only way that a country can resolve that, or one of the two ways that a country resolves that, is the country needs to grow its revenue really dramatically and really quickly on a sustained basis, so that we earn more money, so that the debt becomes a smaller part of our monthly expenses. And secondly, we need to cut our expenses. And he has focused a heck of a lot on trying to reduce the country's expenses. I think that there was a very clear message around that. And then I think
even wishing one of the ministers good luck, if I'm not mistaken.
Exactly right. Yeah, and I think that's the part that's frustrating a lot of South Africans, is that we're seeing a lot of the salary bill in South Africa for government employees consuming a lot of the money that's being spent in the country, and that unfortunately is not going to create economic production. Paying R1 million or R2 million a year to a government employee doesn't create new jobs, and it doesn't help to get an economic growth rate in the country. It's viewed as another form of a tax, and so that's something that's frustrating a lot of South Africans and a lot of investors. And then, as he said, a lot of the other money that the country has is going to pay off interest on debt that we have. So actually a very small proportion of the tax revenue that's been collected on an annual basis is actually going to build roads, build houses, and the like. And I think those are the things that government should be spending money on, so that we can start to get economic growth rates going again. So to me, that was quite uncomfortable, scary budget to look at. But what I am happy with is that I think there is real focus on what needs to be done. They're certainly not candy coating the problems, and they're certainly not saying that South Africa is in a wonderful position and everything is fine. That would have been a real worry for me. I think under the Zuma administration, they would have just swept us under the carpet just to say that the country's overreacting to the problems. Whereas I think this was a real honest look at the problems the country has, and showing hopefully a willingness to address those problems on a structural basis, which is really important.
Yes, you've mentioned building roads, etc. They have been talking about quite a few projects that has come online and that they're looking at. What have you heard around that?
I think that it was really nice to see. I think I don't know if it was orchestrated like that, but I think that it was on the day of the budget or the next day. There was a whole infrastructure conference that chaired by our president, and certainly there they've identified and named 55 key infrastructure projects right around the country that are being focused on now, that have gone not necessarily just from a piece of paper where someone's hoping to do something. It seems to me a lot of these projects are quite far down the road to actual implementation, or at least to tender stage. And what's interesting about those projects is they are focusing, we believe, on the right areas. So, for example, there's a massive economic benefit to building low-cost houses in South Africa. And, if we think about it, when you build low-cost houses, what you're doing is you're using bricks and cement and raw materials that are sourced in South Africa. It's not stuff we have to import. We're using the cost of labor, which is domestic labor. And and then we're building assets that can be used to house people and create a wealth effect for more and more of the population, which is a gift that keeps on giving to the country over years and decades ahead. And the economic multiplier of that is enormous. And what do I mean by that? So for every rand that you spend on building low-cost housing, you create 5 or 6 or 7 rands worth of economic benefits to the country. And so it's important that we have a focus on those. And certainly if I see that, plus the spending on roads, the spending on rail, it certainly seems like the government understands that message. And I think, in addition to that, we saw the Deputy Director General in the Department of Public Works saying that they have no desire for government to be the major strategic shareholder in SAA, as an example. That they're happy that government becomes a minority shareholder and that a private company becomes the key strategic and majority shareholder of a business like that. So if that's a signal of a structural change in the government's outlook into the way that public enterprises need to be run, then that for me is a very positive sign, because I think it might signal that what business has been telling the government for a long time is that government's not great at running businesses. Business needs to run businesses, and government should be an enabler of the right environment, both from a regulatory point of view and from a capital perspective, to create an environment where businesses can grow using the infrastructure that government helps to develop. And we have a very good history of that. If you look at the implementation of Gautrain, for example, that wasn't built by government. That was built by private sector with a mandate from government. And if we look at the toll road that was built from Johannesburg to Maputo, that was private capital that was used to build that with the key strategic direction of government. And that's really the way that things need to be done. So if we see new power plants being built in that way, new railway lines, new roads, new low-cost housing and the like, then we might well be on the right path to an economic recovery from here.
Well, it's great to hear that there are at least some positives that looks to be coming through. I think it's also important probably to talk about what was not mentioned in the budget. Now, a lot of clients are very worried about prescribed assets, what that means for their portfolios, and how that might pan out. What have you seen about that?
Yeah, so just as a brief reminder, prescribed assets was something that was floated by the ANC within their national convention, and what that was really trying to do was to force pension funds, RAs, provident funds to invest in state infrastructure projects. And when it came out, that was really scary as a policy, because the way it was initially floated, it felt and seemed that it was going to force pension fund money to be allocated, for example, to the bottomless pit of Eskom or SAA and the like. And that caused real uncertainty and real insecurity in the retirement fund industry. And if we look at how that's evolved from 2017 to now, we see a real significant change in the way that both the ANC and government are approaching this. So the ANC within their own policy committees are now talking about adjusting the regulations around retirement funds. And just for a reminder for most people, that's called Regulation 28. And what they're saying is they want to create an enabling environment. In other words, allow more retirement funds to allocate more money to the right infrastructure projects if retirement funds choose to do so. And that's a dramatic shift from the way it was initially floated as a planned policy. Because that means that, let's say an Allan Gray or a Ned Group or an Investec retirement fund manager might be looking at projects to say, well, you know what, we're happy to bank the expansion of the Maputo Highway because we see that generates 8% a year's income and 10% a year's growth. And so they're making it attractive for private money and pension fund money to go into infrastructure projects. And that to me is exactly the right way to do this. Create more choice. And if the project stacks up and it's commercially viable, then that's the right way for this to be addressed, because it's very well known around the world that pension funds are really happy to invest in infrastructure projects because they get a lot of predictability around income, they get a lot more certainty on capital generation and capital growth, and they move away from the normal sort of stock market fluctuations. So if the projects are floated in that way and it becomes attractive to pension funds, that's an excellent solution, as opposed to forcing pension funds to allocate money, which is what we saw in the apartheid era in South Africa. And that was a really destructive set of economic policies. So you're correct, that wasn't mentioned in the budget. Our understanding is that it was going to be floated in the budget, but in a question and answer session after the budget, Tito explained that it's something that the industry, both the Financial Sector Conduct Authority, regulator and the retirement fund industry have asked for a bit more time so that these policies can be put together in the correct way and then floated through government and through regulation in an orderly fashion. And so I'm quite hopeful that what was initially a scary set of proposals can come out in a really good way. And I think we need to mention, it's slightly different, but if we look at, for example, expropriation without compensation, again, really scary policy that was floated. And initially they were talking about all property, not land specifically, but property. Property, for example, could be our cars, our houses, our businesses, our everything, not just land. And if we look at how that issue's evolved over time, we see that that it certainly got narrowed in policy proposals to specifically to land, not all property, and then even more narrowly to particular kinds of land. And so we move away from debating whether houses should be taken away, whether businesses should be taken away, and now we're talking about unutilized land and land held by tribal, what might have been in the past tribal lands or homelands, or all those terrible phrases that come from the apartheid era. And we're talking about now unutilized land that could be used for the benefit of more people, or state-owned land, for example, that will be used for the benefit of South Africans in the right way. And if that's the case, then we're talking about good policy decisions that have a huge economic multiplier. So I think, for a lot of us, we need to move away from that sort of apartheid era thinking around land and around retirement funds, and move to a much more progressive entrepreneurial culture, both in government and in business. And if that's the environment that government is hoping for, then we might well be on the right path. I have to say, and I can hear some of our clients' voices in my head when we have these conversations, that these are discussions. These are not certain yet. And we've seen lots of really positive discussions from government that haven't landed as proper policy that's going to be implemented. And so I think that's the part that I would stress is what we're hearing and what we're seeing are positive discussions. What we're not seeing is real economic policy that's actually implemented, where we are seeing change on the ground. The only place that we can see that happening is where SAA has been allowed to go into business rescue, where government has been really hard-lined not to allocate more money to SAA. So that's the first sign that we've got of concrete steps being taken, but we need many more concrete steps.
Well, that's nice to hear. And if that's the case, especially on prescribed assets, hopefully we get certainty a lot sooner rather than later.
Yeah.
So with this economic environment that you've sketched and COVID, the lockdown, clients are asking, is it still worthwhile investing on our own JSE locally?
I think it's a good question. I think a lot of the time when we look at our economy and we look at the rising unemployment and the rising debt levels of the state, it's very natural to say, well, how can that help companies that are listed on the JSE that are exposed to this economy? And that's a really good, valid question to ask. I think it's important when you look at our JSE to understand how is the JSE made up? What are the biggest companies on the stock exchange? Because those are the ones that will attract the most money from investors in the JSE. And there it's important to understand that most of the big companies, if we look at the 60 biggest companies in the JSE, the very large majority of them are companies that earn most of their revenue in other countries, generally either in the developed world or especially in the emerging market world. And their share prices are often determined in other countries as well, because they're not only listed on the JSE here. So if we look at a company like Naspers or Prosus, British American Tobacco, AB InBev, Richemont, the list is quite long, and many of those companies, their fortunes are not attached to the outcome of the South African economy specifically. So I think that we see the sharp and dramatic drop in the JSE that we saw at the end of February and the beginning of March. That wasn't a function of the economic impact on South Africa. That was the response to the economic impact on the world of what COVID could do. And we've seen a dramatic recovery in the JSE since then. And the reason for that is global investors looking at the worldwide situation and saying that they felt that the economics were bad, but not necessarily as bad as being reflected in the stock markets around the world. And the recovery, especially if it happens in emerging markets as well, will be on a sustained basis good for emerging markets. And I think that's the point to make when you look at the JSE. Yes, there are some big companies, for example, the big insurance companies and some of the big banks that earn a lot of their money in South Africa. But for the rest, the big companies are generally not making a lot of their money in South Africa. And so that means you shouldn't be too scared of investing in the JSE because your view there is not on the economic situation of South Africa. It's very much on an emerging market and a global developed world play. And so from that perspective, to me, it's still a relatively safe way to invest. What I would say is be careful of taking big bets on individual companies on the JSE. Make sure you spread your risk. If you're going to be in a unit trust, make sure it's a diversified unit trust on the JSE or an index that's diversified. Don't just buy 2 or 3 individual shares, hoping that you'll make a big recovery there. We are worried about audit standards around the world. We are worried about the balance sheets of a lot of big companies, not just in South Africa, but everywhere. And so we think diversification is really critical in these times.
Right. If we then move internationally, international market seems to be quite expensive. What do clients do offshore?
International markets are expensive in parts. It's incorrect to look at the world and say the whole world's expensive. I think what's expensive is parts of the American stock market, and certainly, when you look at the valuations of some of those more tech-orientated businesses, or telecoms and tech-orientated businesses, that they do look expensive, and they are pricing in, a perfect growth rate for the US economy. And maybe a global economy. And I don't think that that's accurate. So if we look at other parts of the American economy or other parts of the American stock market, one of our beloved shares in the world is Berkshire Hathaway, Warren Buffett's company. And to me, it's very hard to argue that that's an expensive business. So I think that yes, pockets of the American stock market are expensive, but if we look at Europe as an example, not that expensive. Emerging markets are, I think, offering really good value. And I'm not really making a South African comment there. I'm talking about, the whole of Asia, for example, and some of the high growth Eastern European economies as well. So I think that, when we look at the world, it's recovered very quickly from what happened, especially in America, with the initial COVID crash, if you want to call it that, or the Corona crash. I think that recovery was overdone. And certainly when the Americans particularly start to understand that they can't just go out of lockdown back to normal business as usual and going and having big parties and the like, we're seeing a second wave of infections hitting, particularly sort of what they call the Sun Belt in America, the states like Arizona and the like. And so that's going to cause continued volatility and continued uncertainty in the US stock market. So our view is that if you're investing overseas, we don't think it's a bad idea, but what we would say is, if you've got $100,000, don't invest all at once. Take 6 months, phase it into the international markets over time, and don't avoid the US because there are pockets of the US that are expensive. Our view is have a diversified exposure to the US, but also more particularly a diversified exposure to the world, and then feed in your money over time. Because surely there will come a time when scientists will solve at least the treatment and the management of the COVID issue. And once that happens, stock markets will rebound very quickly, even if the economies take longer. So we would hate to avoid the global markets, but what we would say is be careful of investing everything at once, and be careful of being too heavily invested just in the tech sector, for example, in America. That does pose some valuation risks.
Thank you, Warren. And I think one of the most important questions, the question that we get the most, is then we do recommend that clients take their money offshore, but at what rate?
Yeah, and I must say, I can't tell you how many times I've had to dodge the question of where's the rand going to be in December. And I have to say, I'm not dodging the question because I've got the answer. I'm dodging the question because the most honest answer is none of us have a clue where the rand's going to be against the dollar or the pound by the end of this year or next year or the year after. And what we can say is we can come up with what we think is fair value for the rand. And our view is that if you're going to convert your rands into dollars, we think that a level of approximately 17 to the dollar is a good level. That's probably the right level. So if the rand is close to that level, it's probably a good time to convert your rands to dollars if that's what's appropriate for your financial position. If we look at the pound, we think about 20 Rand 50 to the pound is a good level. And I think the rand's been quite a lot weaker than that for quite some time. So it's probably worth being patient with converting your rands to pounds. But if the dollar is close to 17 Rand to the dollar, then, or I should say if the rand's close to 17 Rand to the dollar, then that's probably a fair time to send the money out. Once you're on the other side though, then be much more patient with feeding that money in. If you're absolutely panicked about South Africa and you think that the country is really in a terrible state and you want to convert your rands to dollars or pounds at any level, what we would ask then is that you also do that in patches, in phases. Please don't do it all in one shot. So if you're not going to wait for 17 Rand to the dollar, then at least spread that purchase out over 3 or 6 or 9 months. Don't make one big call at once, because we just think that we've seen this movie before. The Rand does swing back in a big pendulum motion from being far too weak, potentially it moves to being a bit too strong again. And at the moment, we think it's certainly a bit too weak against the pound and slightly too weak against the dollar.
Thank you, Warren. I think that makes it very clear for the situation where we're in currently. So thank you very much on this very cold winter's day. Apparently, one of the coldest winters in 10 years.
Yeah, and it's amazing to see, if we look at the weather patterns around the world, apparently temperatures of 38 in the Arctic, so that's quite scary to see. But just for our clients that are still unsettled in these times, which we think is a completely normal and natural response to the conditions that we're seeing, it's important to note we're not sitting here and saying to everybody that we think the South African economy is in a great state. We don't think that. We are really worried, and we are watching the space very carefully as to what the government does next. We think that the time of being able to talk endlessly about implementation and talk endlessly about development plans and committees that will get things going, we think that time is running out, and we do think action needs to be taken. What we are very positive about is that we think there has been a structural change in the way that the government is looking at the economy. In other words, they are saying this is not the time for the state to do everything, for the state to build new power plants, for the state to build new railway lines and roads and houses, etc. And they are seemingly working much more closely with business than they have in the past. So that's the part that gives me hope. We have seen the first few big infrastructure tenders actually going out, and we look at Raubex, for example, one of the listed companies on the JSE, that have put out some announcements about their own results, where they were saying they're seeing many more tenders for roads that have actually been published already. And if we see that starting to pick up pace and pick up momentum, that will have a very big impact. So we're not saying that everything is great, and certainly we often get accused by some of our clients who are really worried about being too optimistic about South Africa, and that's certainly not the case in this environment. But what we are saying is that there are reasons to keep watching the space, to see the turn in both the economy and potentially the fortunes of companies, especially smaller companies in the JSE. But it's something we're watching. We're certainly not making that as a forecast now. And that's one of the reasons why we are comfortable to be a bit patient around the Rand, because we think a lot of the Rand's movements are being driven by international factors, not about domestic factors. It's not a price on the economic policies of the South African government at the moment. It's really a function of how investors feel about the unwinding of the COVID crisis. And once they feel optimistic that the world has got a grip on this COVID issue, we will see a recovery in emerging markets around the world. The Rand will certainly benefit from that, despite our economic issues. So I think that's really our view now, is it's time to try and look through the next few weeks or few months and trying to understand how the world's going to perceive the economic recovery from here, because that will drive our market in the short term.
Great, Warren. Thank you. I think that was really worthwhile, and appreciate that.
And all the best for the rest of July. We hope that it's certainly the weather turns warmer, but I'm sure the people in the Cape are really grateful for all the rain. So let's hope for continued rain down there. And all the best to everybody. Please stay the course and stay in contact with us if you are uncomfortable or worried about the markets. We are here to chat to you, even if we're not. As you can see, I'm at my house. Even if we are at home, we're certainly operating at full steam. I know some of my colleagues would say they're even more productive at home than they are at the office. I'm sure that can't be true, but we are here for you, and we are ready to help.